Coming up on this week's Redcast.
I think one of the main trends that we expect to see is the death of anonymity. The key risk here, I think, needs to be focused on not just in the space of AML, but in the other less well-remembered space, which is TF, terrorist financing, proliferation financing, things that are potential existential threats.
The standardization makes this stuff work. That standardization is harder when you're doing it cross-sector. But what people are interested in is maybe more of the common threat-based approaches. What's the policy of the major VASPs towards DeFi mixers? I think we've had an evolution of attitude that most people do not want any exposure to the dark web unless it's very clearly managed and mitigated. Do we have the same appetite towards DeFi mixers? What about privacy coins? Are we only going to accept configurable privacy coins that are accessible by law enforcement when they have a person of interest?
It's compliance node or reg node, and how we get that better collaboration between incumbents, startups, innovators, whether they're startups or incumbents, and regulators and policymakers.
Really, we are at that point where the dog may actually catch the car. I mean, we've been talking about the cars whizzing by, and it wouldn't be great if we got our chops around that bumper. But it does feel like, timing might be right to have some of these real meaningful conversations that do push that dialogue.
Welcome to Redcast.
Shining a light on challenges and opportunities for digital compliance.
Welcome. I'm PJ DiGiamarino. In advance of our economic crime seminar here at JWG, we've been taking a look into a lot of the economic crime and RegTech challenges that are upon us this year. And let me tee up this episode because it's pretty broad, and we have a really great cast here to help us unpick the bones of it. TradFi has long been expected to perform miracles with AML and terrorist financing. There are numerous rules across the globe that have to be assimilated by large organizations, and there are big penalties and risks if they get them wrong. Not a lot of prizes for second place when you are able to catch things. By some estimates, a lot of things are getting through, and I think the FCA famously in their tech sprint highlighted a statistic saying 99% of economic crime that goes through TradFi is undetected. So there are lots of new things that regulators have been exploring in terms of access to registries, public-private partnerships, better data sharing. All that are emerging just in time for the DeFi debate. The DeFi debate has been raging for a bit as well, but with sanctions escalating and the market cap varying wildly, there are a lot of opportunities to review those rules ongoing. So all this, from our perspective, means it's time to start looking at what happens next. What happens when we get the go-ahead to look at how we think about implementing these rules in better, faster, cheaper, and safer ways. And that's what we're here to talk about today in advance of getting let me try again. And that's what we're here to talk about today. So who better to tee this up than two trade association gurus in this space and a regulator who's doing some of the thought leading. Brian, can you please introduce yourself first?
Absolutely. Hi, everybody. I'm Brian Yeo from the Financial Services Regulatory Authority here at Abu Dhabi Global Market. And I look at tech and data governance, which includes building out the policies for managing the fintech ecosystem and the growing virtual assets ecosystem here in the UAE. Most recently, we put out a discussion paper on DeFi and how we see the market evolving and how it might be regulated. So pleased to be here and share insights and learn from the other colleagues.
Thank you. Thank you, Brian. Nick, can you tee up your role, please?
Thank you. I'm Nick Van Benschoten from UK Finance. I'm part of our economic crime policy team working on international illicit finance. We did a white paper last year about banking crypto assets, where we worked with a number of other associations, including Crypto UK, to discuss how do we reduce urban myths between TradFi and the emerging crypto sector.
Thank you. And certainly, last but not least, Lawrence.
I'm Lawrence Wintermeyer. I am the chair of GDF. GDF is a members association serving the crypto and digital asset sector globally. And we do standards and codes of conduct and advocacy work. We've got over 150 firms in our code program, and particularly focus on all of the emerging issues that you're speaking about around DeFi, stablecoins, which is a particular hot topic in the Western world, and AML, and certainly popular again as it relates to crypto sanctions and this wave of sanctions we've seen with the Ukraine crisis.
Thanks, guys. It's good. Really looking forward to getting your perspectives. I think that the first question that we wanted to tee up was, which economic crime risks are really most material now, and what's the real potential for RegTech in this space? I mean, Brian, you've just come out with this paper. It's still in discussion for sure, but can you help explain how it's framing the challenges for DeFi?
Absolutely. So I think we've put out a discussion on paper on DeFi that sets out where we think key trends will eventuate in the space over the next 5 to 10 years, and come up with certain policy positions that we've taken based on our expectations of these trends. I think one of the main trends that we expect to see is the death of anonymity. That's something that I think will have a significant impact on MLTF risks in the DeFi space. This death of anonymity comes from two sources. First, it comes from a top-down approach, which is a regulatory action, and a bottom-up approach, which is concerns from the industry. So I think let's talk about the regulatory action first. I think there's been significant concern among the international regulatory community over the past few years, and this has, I think, only been heightened over the past 2 months with the Terra Luna crisis. But various organizations, the OECD, the BIS, the FSB, the FATF, the whole alphabet soup of agencies have come out setting out certain risks that they associate with decentralized finance. And I think that is a signal that action is likely to come. It may not come now. It may not come in the short term, 1 or 2 years. But in 5 or 10 years, I think there will be some level of push to start addressing the concerns that are raised by anonymity. And the key concern, the key risk here, I think needs to be focused on not just in the space of AML, but in the other less well-remembered space, which is TF, terrorist financing, proliferation financing, things that are potential existential threats. So for example, the classic example for this would be the Axie Infinity hack that happened in March this year. $600 million was lost to an attack on a bridge, and that $600 million was later traced to North Korea. So $600 million was lost in a year, to the Axie Infinity hack, and that buys an awful lot of nuclear operationalization from North Korea. While we can see who has obtained these illicit funds, we can equally see that they are being put through greater anonymization through mixers such as Tornado Cash. And it may be challenging in the future to trace how these funds exit such mixers. So that's on the top-down space. But on the bottom-up space, I think there's equally a lot of push from participants due to the fraud that is happening in the DeFi space, such as rug pulls, which are facilitated by anonymization, but also through the inability of investors to make informed decisions because they do not know who the founders of their projects are. So for example, Terra Luna, it's not clear to us that people would have let Do Kwon have $2 billion worth of Bitcoin in his hands if they knew that he had been associated with another failed algorithmic stablecoin that failed in the same way. So I think it's not all gloom and doom. There may be a death of anonymity, but there may be a rise of pseudonymity, a way for true identities to be identified based off of technological solutions. And this is where we think RegTech has a great potential to help solve this. It will help address people's legitimate desire for privacy while still being able to address the kinds of existential risks that we may see facilitated by virtual assets. And I think that's only appropriate. Paper processes may struggle to deal with digital problems, and RegTech solutions, whether through blockchain analytics firms, whether through identity registries, abilities to trace the registers, are a potential way of resolving this circle so that we can enjoy the benefits that virtual assets give us while addressing and mitigating these risks.
And Brian, in terms of your timeline, you talked about 5 to 10 years for the top-down action. You don't see that happening anytime soon, but certainly the bottom-up drivers you spoke about are very, very much market drivers and very commercial. You're expecting those to be kicking in now, right?
I'm expecting there to be an increasing push. I don't expect them to have a full effect that will force everybody to be to reveal their names now. But clearly, I think the fact that several founders who were previously pseudonymous have started self-doxing themselves to verify that they are who they say they are and that they are trustworthy is a good sign for the future. And by the way, one quick point I'd like to make. This mitigation of risk is a huge opportunity for DeFi. If you can address these MLTF risks, DeFi solutions can integrate with the mainstream of traditional finance. And that lets them tap on an incredibly larger liquidity pool. So, I mean, for example, the entire TVL of DeFi was at peak about $250 billion. That's only about 6% of JP Morgan's total assets. The ability to tap on the existing mainstream of finance is a huge driver for virtual assets.
Let's get Nick involved here, because I think this probably falls right into his wheelhouse. I mean, Nick, pseudonymity and the broader conversation about how do you bring these actors and assets into the regulated financial services system is a bit of a minefield. How do you think about that, the challenges in that space?
So I'm speaking from a UK finance perspective. We've got quite a wide membership. So we've got challenger banks, we've got payment fintechs, we've got traditional banks of all sorts. We've also got card acquirers. And I think the challenge now is coming in that people are trying to deal with a regulated crypto sector. So they're trying to deal with it also as a standard asset class that increasing number of their customers want access to. The key challenge I see at the moment is that whether or not blockchain is fully transparent, it's not easily understood by a number of our firms. They don't play well with the firm's systems. There's also a little bit of concern, potentially overdriven, but it is out there, about the use of DeFi mixers, about privacy coins. And then you get the regulatory expectations coming, at least in the UK, very firmly, no watering down a source of wealth standards. You have to fit DeFi into the current AML regime that was designed for the days of checks. So there is a challenge that I see at the moment that people are trying to, as it were, swallow the elephant whole. And a lot of people, their reaction is that it's just too rich for their appetite. Their risk appetite, they're not willing to accept it. Now, the larger firms don't really have that stance generally. They will have a more sophisticated view. Whether you're open to crypto as a customer class, you can't avoid exposure to crypto. So a lot of people are spending money, as Brian said there, on a lot of the new RegTech solutions, including blockchain analytics. But again, looking across our membership, there is a risk of people getting a knee-jerk reaction. Quite a lot of the blockchain analytics, the price is coming down alongside a lot of other RegTech solutions, but there's still an overhead for management oversight, for risk assessment, for expert review. And for a lot of people, that doesn't really match up with the kind of cost-benefit analysis for those clients. It's kind of easier asking those clients to either go down the road or asking them to actually pay an extra premium, which is, again, not the way you want that market to mature. So just looking at this question of opacity, I think there is a little bit about opacity of understanding, and that's quite important. When you look at the traditional financial sector, there's an entire industry about reliance, about KYC standardization, about the body that we're a member of, Joint Money Laundering Steering Group, that does AML guidance. That runs to 200 pages for the standard chapter 1. Chapter 2, the sector-specific guide, goes into another 200 pages. So standardization makes this stuff work. That standardization is harder when you're doing it cross-sector, but I don't think there's a 200-page publicly available guide out there for crypto for people to reverse engineer. So opacity of understanding, that's a key thing. That's something we're definitely trying to support at the moment. I referred to urban myths. One of the urban myths is that you will only get IDAV rather than full customer due diligence on crypto exchanges. That's just increasingly not the case. That's a lagging understanding. But what people are interested in is maybe more of the common threat-based approaches. What's the policy of the major VASPs towards DeFi mixers? I think we've had an evolution of attitude that most people do not want any exposure to the dark web unless it's very clearly managed and mitigated. Do we have the same appetite towards DeFi mixers? What about privacy coins? Are we only going to accept configurable privacy coins that are accessible by law enforcement where they have a person of interest? How do you then code that into DeFi so that everyone's operating on that standardized, systematic basis? And like I said, the traditional financial sector is quite complicated, maybe too complicated at times. It has sector-specific approaches, but there's been a lot of work in getting them interoperable. So I think if we can do it, then, and I would concur, DeFi is a great opportunity to do that with modern technology, but you need to address the problem. And the problem is criminals know how to exploit new technology. The thing we don't want is for DeFi to take its place alongside MSBs, alongside nested relationships and virtual IBANs as bits of the infrastructure that are being abused as just one tool amongst many. But we've seen how those tools combine and quickly get out of control. So I think the key thing is let's try and understand each other, but also work together collectively across sectors to manage the risk, rather than arguing about whether someone's being forced to act like a bank or whether somebody doesn't do proper KYC. I would hope we're past that now.
Yeah, and I really like your shout out to the joint money laundering steering group guidance. I mean, it is a massive, massive work. One of the applications from a RegTech perspective is you really need that guidance to go down to a process level. And right now it kind of sits above that. It's really more of a principles-based document. How do you see with the advent of the DeFi conversation, the need to go deeper, and will that happen?
Yeah, I think there's a reason why it stays at a fairly principle-based level. That's because different firms have different business models and different risk appetites, right? But I think you can definitely start to look at how do you get it into a bit more of a standardized basis so that you've got an agreed escalation protocol, some agreed criteria. JMLSG is written for policy experts and legal experts and operational project leads. It's not written for coders. So I think you make a good point there. There are some RegTech tools out there that take guidance, whether it's JMLSG or other countries' regulatory standards, and turn that into a sort of lexicon and a language that spits out gap analysis. So I'm sure there are tools out there. The thing for me that's difficult is the more transparent you get, and this may be something about the level of detail you get in industry guidance, the easier it is for criminals to reverse engineer things. We have a number of initiatives that we do on a membership basis, and a lot of that is presented at a very vague level in public. We just don't want it reverse engineered. Now, I'm sure there's a similar approach in the crypto sector with VASPs and others being quite careful about how they balance the market confidence bit of their communication with the risks of being exploited by criminals, working out what the thresholds are, how to game the system. And that's going to be an ongoing activity. We're still trying to work that out in terms of card not present fraud. Every single bit of solution we devise quickly gets undermined, and we just need to keep on top of it.
Lawrence, let's come to you on this. And your group has been extremely active, and you want to spend a minute talking about those activities. That's great. But what is the right role of standards in this kind of conundrum?
That's a good question. From GDF's perspective, certainly the right step forward for standards are the players who are doing things right and trying to do things right. And particularly, second guess regulatory uncertainty is a good start. And so in our case, our members are focused on consumer protection, on stable markets and identifying risks. And so we do it through the development of codes of conduct and other standards. And so I think, even listening to this discussion, this is part of the issue that I think crypto and digital assets has. And broadly, it's a larger discussion. I always try to put it into context. And I have to admit that after UST, which again calls itself a stablecoin, but looks like a synthetic derivative, it's often difficult for me to even make these cases because people are saying, look, this is just, this is back to the Wild West, or quite a few pejorative terms that people do use about the sector. But I think first and foremost, most people in the sector are law-abiding. They're ex-capital markets, ex-regulators, folks, and they're trying to do the right thing. But digital is global and borderless, and exactly, criminals look to game anything, and so it's a broader issue in the cyberspace and with digital, and something that I think we're going to have to just become a more familiar with for the reasons that my two previous guests have focused on. But B, then in that, help us think about how we work more collaboratively, to come together to solve it. Which is, I believe what we've done well on the RegTech front, and there are a couple of instances that I'd like to raise. But what I would say certainly is the period we're in now, one with macro instability and certainly some of the additional instability that's brought on by the Ukraine crisis. If you look at regulators, and particularly U.S. regulators, it looks as if the path is more innovate by enforcement than any collaborative form, because there are just so many things to pick on. And you've raised DeFi. We've been focused, particularly on all of the standards to get VASPs to FATF-R16. And we've developed with industry IBMS 101, which is the inter-VASP data standard, which I like to call the SWIFT standard, which folks in the crypto community don't like. But that has been a huge area where we've certainly led on standards. And, again, there's more work to do. I think, if you listen to FATF, part of the bigger issue is that jurisdictions are having difficulty implementing it. There are more concerns around, sunrise issues of VASPs being in one jurisdiction that has implemented R16, counter, doing business with other VASPs that aren't. So that there are a number of things that need to be moved forward or accelerated just in the traditional VASP or crypto exchange space before we get to DeFi. I'd only comment on DeFi in that IOSCO's report, we felt as an industry association did a very good job of outlining the risks, as did the OECD report. There are a number of reports around. WEF have a report out as well. But what I would say is that we all appreciate in the industry that total anonymity, particularly at a consensus level where we're trying to build mutual structures, is not going to work in this world. And it may seem a funny parallel to relate, but anonymity in social media doesn't seem to work and has its problems. So we've got a bigger issue around digital identity as we go forward to things. But just to come back to your RegTech question, there are two specific cases. I mean, we've worked very closely with a number of the data providers that are our members that my guests are familiar with, Elliptic, Trim Labs, Chainalysis, who've all done an outstanding job on sanctions. We pulled together a sanctions task force, worked closely with the National Security Council in the US and Treasury and OFAC, as well as the UK Treasury, the Europeans. And we sanctioned 15 million wallet addresses pretty quickly. I just don't think that kind of response happens in an analog environment, but it's certainly one of the benefits of the transparency of crypto digital assets, in particular things that are publicly on-chain. And so the ability to be able to identify transparently any counterparty in the network system that in this instance falls foul of a sanction, I think illustrates the strength of the technology. How comprehensive that is out of 100? Well, it's closer to 100 than it is to 0. So it's a very good start. On RegTech, particularly as it relates to VASPs and central exchanges, our members have a working group that we have up and running with regulatory purview that's focused on market stability and cross-market, broadly cross-market reporting through VASP order books. And so we think this is hugely important because this is actually closer to a subtech, a regtech solution, things that you do anyway, JP, which allows the industry to more transparently demonstrate that it is conducting itself openly and transparently. And again, I would hope we would get a regulatory node on that. I think just coming back to your point on DeFi, and specifically, we're talking about the DeFi ecosystem and the rise of decentralized finances and consensus, algorithmic consensus models with automated market making and pooling liquidity and automated market making. That definitely is an area that we're all focused on and engaged with regulators. I think it is more problematic in that some of it does look, more centralized than you would think, certainly for people with a cap markets background. Automated market making itself is quite interesting, compared to traditional, bid offer spreads and the way, order books are put together. But I think what I would say is that in my own world, and I believe someone mentioned it, the importance of identity and provenance, I think, will prevail in that market. And then there's, I think, probably a bigger use case in traditional markets as we digitize and put, traditional securities and or commodities or other assets on chain, particularly around that technology. So I think moving forward, we'll see institutions have a great interest in that because that, DeFi and certainly the constructs of DeFi, but with a greater degree of anonymity, to the ecosystem and legal identification, really are the roadmap, the future to certainly wholesale banking.
Yeah, and I love the way you sort of pulled out some of the policy issues there, but also the risk framework in the way people at the moment need to now look at and agree what some of those key risk nodes are and think about how they're going to mutualize their understanding of them better. Because I think that is at the heart of a collaborative approach that will bring regulated, and supplier all into alignment.
Yeah, and just to add to that, particularly in a DeFi network where we do have legal identity and consensus, having a compliance DAO and a reg node or reg nodes as part of that, even as part of the the tokenization of the standard that players need to hit, would be, from my perspective, the direction that is going. But I think back to one of my esteemed guest comments, that'll be the next 5 to 10 years to really work out how we construct those models of engagement.
Yeah, but at least this gives us the opportunity to start talking about those different kind of models. Yeah, right. Absolutely. And I guess the thing I love about this conversation, refreshed for these kind of digital assets, is you can think about digitally native compliance. And you can think about shared solutions. You can really think about common protocols. You just can't. It's very hard in a TradFi environment when you're sitting there facing this wall of payments and wall of customer onboarding and all these the solutions that try to help you manage a particular risk silo. It takes a lot of work to kind of rise up above that. And I think that, to one of your points, that we're sort of there now, where that's the clarion call.
Well, I don't occupy time here, but when I was at Innovate Finance and working on the sandbox consultation with the FCA, my offer to Chris Woolard, even in the TradFi world, was, as a pretty experienced big data person, really, if you were to just deploy big data and ML solutions, you could probably do a pretty good job with a regtech subtech solution in TradFi, but that's too difficult for all sorts of reasons. So I would say that certainly blockchain and DLT technology do offer us the next avenue for doing that with that sort of network node consensus participation.
Amen. I guess so. So just moving to wrap up, because shockingly we're already at that point. I guess what I want to focus on the big agreements or disagreements that you guys are most looking forward to at our June seminar. I know you're involved in some way. Brian, let's start with you. I guess, you know, what are some of the big discussions that you're really hoping to get involved with?
So there's two. So I'll be greedy and pick two. First is whether we can agree that the right to not be blown up by illicit nuclear weapons has a bearing on how you think about your ability to have privacy in the blockchain, right? I suspect many people will agree that not being blown up by nuclear weapons outweighs the right to privacy. That's one. The second is, what I'd like to see is, to what extent do virtual asset players, especially DeFi players, think of their users as customers versus counterparties? Because the way you treat a customer and the way you deal with a customer is very different from the way you deal with a counterparty.
But eloquently stated. I think that fits nicely with a lot of the pseudonymity type conversations and the broader standards questions. Thank you for that. Nick, what's your perspective on the same question?
I'm not going to comment on the data protection public policy balance, but if you've read the recent paper by the European Data Protection Board, I'm not sure they would come out as clearly as we all would. But anyway, leaving that to one side, I think it's really interesting, the question about counterparties versus consumers. In the traditional banking sector, we have issues with money mules, right? So they're people who have been legitimately onboarded and they just sell the use of their accounts in a very sophisticated organized crime network, and they're a nightmare to follow. And we've had to do network analytics to map them. And when you map them, you realize the problem is it's not even a needle in a haystack. It's a piece of hay in a haystack. They are normal customers. So it goes back to the point of EID. Let's forget about synthetic identity for a while, shall we? But let's just say legitimate customers, how are we all going to manage them? And I think from the experience that we've had, you need to realize it's no longer going to be just multi-banked organized criminal gangs. They're going to be multi-platform, multi-sector. We're going to have to share intelligence across those different divides. We're hopeful the new economic crime bill will have powers for all types of economic crime information sharing, not just fraud. What we don't know is whether it will go beyond the banking sector. We sincerely hope people will see the rationale. The question I'd like to know is whether people are up for it. You know, are we up for, if we get the power to do that sharing on protecting our mutual customers? Because it's all the same customers, unfortunately, getting exploited across multiple platforms.
Yeah, and as you and I have spoken about in the past, it's no longer just theory, right? Where Singapore has got Cosmic, it's up and away. Yeah, so I guess that things are fundamentally different now, and you know, the time has marched on.
It has, and just to finish off, I mean, our network analytics shows a few years ago it would have been MSBs, but now it's unfortunately crypto exchanges. The money mule herders are finding another weak point in the system. They're flooding money through. Now it's fiat origin crime, it's proceeds of fraud against a bank or so on, but it's going through another sector. If we can't follow the data, we can't follow the money. We can't interdict here. But if you're thinking about it on a pure counterparty basis, you may miss the fact that it's actually all of our same customers.
Yeah, that's a great point. It's the complexity of the multi-platform, multi-customer, or similar, same customer on multi-platform, and needing to think about a common risk framework and the ability to get the data. Yeah, Lawrence, what about you? What's the big disagreement or agreement?
Well, I don't think there's a big disagreement and agreement. And I think, you know, most folks that are focused on either consumer protection or protection of the system and financial stability all want the same outcomes. And, you know, broadly, this is digital that we're talking about. I mean, you can discriminate and say crypto is an application for this or something's going on here. But you know, from my perspective, this is an increasing issue in a globally digital world, again, where digital is borderless. And for all of the reasons my, you know, two guests have highlighted. But I just picked PJ, it's up to all of us to work out how we can better collaborate to move the dial. So your number on FCA detection was they reckon they detect 1%. FATF's global detection numbers are similar. FATF has been going since the Contra War, fair in the US when it was set up, 40 some years ago. I'd like to be on a conversation, certainly on the road to my retirement over the next decade, where we're moving that 1%. And so there's an opportunity really for us to come together to deal with the issue of legal identity and digital identity, which is going to be critical if we want anything in the great digital, stratosphere to work for into the future and for our children. And then most importantly, to have a very good look at blockchain and DLT technology, particularly for the transparency that it offers and the greater transparency, particularly with identity, where we need identity or pseudonymity or whatever the term is for transactions we need to protect from overt identity, and which we need to do for many different reasons, certainly in financial services. Because I do believe, and I wouldn't be sitting here, as a board member of GBVC or the chair of GDF if I didn't, that this technology, certainly in my 30+ year history in financial services, really does offer us the best opportunity to get the next bit of the journey right, and not to be, again, as one of my esteemed guests said, trying to retrofit regulation that was regulated for technology from a different era in this new digital world, which just doesn't always work for all sorts of reasons. So if we can pick that off, and I think my destination ultimately is, it's compliance node or reg node, and how we get that better collaboration between incumbents, startups, innovators, whether they're startups or incumbents, and regulators and policymakers. That would have been a great RegTech conference from my perspective.
Well, thank you very much, gentlemen. I guess my premise for this conversation and the conference is that, really we are at that point where the dog may actually catch the car. I mean, we've been talking about the cars whizzing by, and it wouldn't be great if we got our chops around that bumper. But it does feel like, timing might be right to have some of these real meaningful conversations that do push that dialogue and look at how do we leverage common technologies to confront a whole network. And I think that's the, one of the themes we gotta keep getting back to is, okay, it's not the same old time they said, no, go away. There's actually an opportunity to engage here, and how do we do that right? So without further ado, I thank you all very much for coming on in here today. And for those of you listening, please join us on the 23rd of June. Check the show notes for details. Thanks again.
You can download the podcast via Spotify, Apple, and Google. But also I'd encourage people to come to the JWG website, which, as hopefully you will know, is jwg-it.eu. Go to the Intelligence Hub and create your bespoke library. This is RegCast.
Shining a light on challenges and opportunities for digital compliance.